Hello everyone, and welcome to Update on the Economy, Powering Forward. This is going to be a little more disjointed than my meetings usually are because it's been quite an eventful day today, to say the least. However, I'm really committed to making sure these happen on time as to the best of my ability, but my notes aren't nearly as organized as I would like them to be. But I'm here for you. Here to talk about all of the things going on in the economy. Thank you very much for your questions in advance, and I am prepared for any questions that you have going forward today. The best webinars are the interactive webinars, so if anything I say triggers a question, if you have questions, put them out there. Even if you think I may cover them, I love to customize this to the group. So I wish I could have changed the name of the webinar or the title of the webinar about a week ago, but it takes too long to get all this stuff approved and to go through the process. So I'm going to change the name here for all of you, which is, we have some cracks in the veneer. There are some concerns appearing on the horizon. This is not designed to worry you, to frighten you, or cause you to run for the hills. It means things happening, bear watching. At this point, there are far more positives, far more strong data points than weak data points, but there are certainly concerns. By the time I do this webinar next month, we're going to have a lot more clarity, and even more so by September. But everything I say today is also, some of this is in a watch pattern. So I have the questions here. I'll talk about a few things, and then I'll kind of talk about the why. Overall, though, the economy is still powering forward. Things are still strengthening. As more and more of the country opens up and more parts of the economy can begin working somewhat normally, things are opening up. Yes, we've had some setbacks recently, especially the emergence of the variants and the effects of that. I'll talk about that in a moment. And yes, inflation is clearly becoming more than a transitory event in many aspects. Some of it is, some of it isn't. But as a lot of the questions that came in specifically around inflation, so I'm going to take a moment to talk about that first because it seemed to be the top concern. And then I'm going to get a little bit into talking about the potential impacts and ramifications on the economy in relation to COVID, the variant, the Delta variant of COVID, and how that may have an impact on the economy. And I will also talk a bit about where the concerns may be and how to address them, and also where the opportunities may be. When I say concerns, it only means that this superheated growth that we've experienced over the last few months is going to slow. When I say superheated, imagine if you're driving a race car, okay? Maybe it's fun and it's exhilarating and you're going around those turns really fast and you're doing all these great things, but there's risk involved. There's risks in how you take the corners. There's risks in how you control the vehicle. There's wear and tear. Lots of things happen when things are moving at very high rates of speed. And that happens within the economy as well. Extraordinary amounts of stimulus that came into the economy. I would say nearly all of it well-intentioned and a lot of it poorly executed. I'm speaking from an economic viewpoint, so I understand that some things I say can be seen from a lot of different ways. So please take me for what I am, speaking here economically. A lot more money was poured into the system that was necessary for economic reasons. And that's causing parts of our economy to overheat. Okay, where better to see that is in, say, real estate. And before anyone says, oh, that means it's all going to crash, things can overheat and then stabilize. Things can heat up and stabilize. Things can grow massively and stabilize. Just because it goes up quickly does not mean it's going to fall down. And that's an important consideration there. But very low interest rates combined with a lot of money in the system, combined with people rethinking their lives, causes the effects of that. It's largely what led to the rapid rise in the prices of lumber. That is one thing that turned out to be transitory, by the way. We're down just under 50% from the highs that we experienced back in May on the lumber prices. You maybe don't see that yet at Home Depot. Well, that's because it takes a while for them to sell off the lumber they paid those prices for, but it is being seen at the source. Oh, it is. And why? Things open up, people come back to work, prices are amazing. What companies not want to go out there and produce as much lumber as possible and get it out to the places that need it? So some parts of the inflation we're experiencing are more transitory, some are more entrenched. And each month that goes by, and each month we see the data, they become more entrenched. And I want to say inflation is one of the really big concerns, not so much for the reasons that some people think. It's more so because it's a big concern for the ability for the current administration to do a lot of the things they want to do. The economy matters. It really, really matters as far as politicians' ability to get elected, get reelected, and get a lot of policy done. And this is an important, so that perception of that and the concerns around that are largely why President Biden did an unplanned economic press conference earlier this week. He really wants to get out his message or his viewpoints on where inflation is to assuage concerns that a lot of people have had around this subject. Why does it matter? It really depends. The people that are most affected by inflation, being really generalistic here, inflation is, demand is higher than supply. It's really that simple. If you want to buy a car right now and there's no supply, you're going to pay what the dealer wants you to pay. There's no negotiation. If you go in and everybody's got tons of cars and everybody's competing with each other, you may be able to negotiate the car price. It's very much the same with everything else. There are things we need, okay, there's not a lot of negotiating power on, like our power bill. And then there's things we want that we may pull back on if prices rise too much. So that's a layer of costs. So if you want something and you don't need it, you can decide not to buy it if the price is too high. If you need it, you don't really have a choice in the matter. If you're living off of a fixed income, you have a limited ability to raise the amount of money you're making in order to pay for higher costs. And that in itself is a concern. So these are all things that we want to watch for and take in consideration of what areas of the economy are prices rising and how much of an impact will it have on the greatest number of Americans. We're seeing that with gas prices. Gas prices are essentially a regressive tax on primarily lower income individuals. Why is that? Yes, everybody's paying the same amount for gas, but who does it impact the most? It impacts the people that have to drive further distances to go to work and fill up that tank each time. I mean, gas is approaching $5 a gallon in areas. That's a big jump from where it was just a short while ago. These types of things, while prices are beginning to moderate with things that are taking place in the Middle East, they're likely to continue, especially with a lot of our push now towards finding non-fossil fuel sources of energy. With the green energy bills and a lot of the proposals that are coming out is to get more alternative energies out there, more wider used, right? Get more charging stations out, have more people driving electric vehicles, less dependence on fossil fuels, etc. But the technology to provide that has to be there to make that transition smooth without driving up the prices. So when I bring this up, because the inflation of, say, gas prices are many faceted and much more complicated than just what's happening around COVID. It's policy, it's demand, and it's what's the alternative, right? And this can stay with us longer. Wage inflation is one of those things where there's a thought towards it. Well, that's a good thing, right? Workers are making more money. Workers are making more money. Where that becomes challenging is workers are making more money, but their cost of living is going up as quickly. So, hey, I'm making more money, but the cost of living here, I'm making more money. And then that's when things start to spiral, because at some point, something has to give, right? So I'll talk a little bit more. This is kind of like that broad example. And again, I'm waiting for questions to come in on this. So please send your questions over, because this is something that there's getting a lot of interest. But there was a question, a few people saying, what does inflation even mean? What does that mean? It means that the costs are rising, having a noticeable impact on your purchasing power. Some things are discretionary, some things are not discretionary. Some things you see directly as a consumer, other things are buried in the costs of things that you do. So if the cost of raising a cow goes up significantly, the cost of the whole process of processing a cow and the cost of delivering it to you goes up significantly. When you go to buy beef in the store, you see that price. You don't see all the inputs along the way, but each new higher input along the way is all eventually rolled into the price for that piece of beef you're buying, or for the vegetables you're buying, or for any other products you're buying. Services as well. As costs go up to provide services, the cost of services go up. And that has an impact. We saw a lot of that around the pandemic when restaurants were increasing their prices because their cost of doing business went up significantly during that time, and they were limited in how they could provide the food. So you saw some of these temporary things, some of these are longer term things. The biggest challenge for a lot of the restaurants now is not demand, it's workers. We probably all at this point have heard, I've talked about it at previous webinars, the challenge of getting workers. This seems like it's becoming more and more and more entrenched. The talk is, oh, just wait for September when the extended unemployment runs out. It's a little too soon to tell yet because this just started the end of last month. But a lot of states actually ended their extended unemployment early because they didn't feel there was a need for it. And we're watching closely to see what those unemployment numbers look like there. But it's becoming less and less probable that there's going to be a major change. There's a lot of other things causing people not to go back to work than the extended unemployment. When the kids go back to school in the fall, assuming now, and I think they're really trying to stick with this, it's really important that schools open as expected across the nation, that will be another big indicator. So the cost of wages rising, as long as that cost can be passed on to the end user or the consumer, it's sustainable. And it's not necessarily a bad thing. The people that were most impacted during the 10 years or so, or 12 years since the financial crisis ended until the COVID period, in that period of time, the people that were most impacted, that saw the least benefits from the economic growth in that period of time, were the people at the lower end of the wage scale. Low inflation creates low wages, especially in jobs that are easily replaceable. So there's some benefits, societal benefits to it. Economic benefits, again, if the employer can pass the cost on, it's not really going to be a major impact on the economy over time and overall. So that's that consideration there. I want to talk a little bit about, because there was 3 or 4 questions here specifically stating that around inflation, is this going to be like the 80s, like the late 70s and 80s with the technology, with the inflation? It's difficult to say at this point, but there's something I really want to stress. How is inflation categorized now as opposed to how it was categorized back then? So the government's official inflation measure is a basket of goods and services called this Consumer Price Index. And that basket changes over time as to what it consists of. So I'm going to give you a couple of examples. There's 2 components to it to understand. One is that they can make substitutions. So for an example, the idea is if the cost of steaks rise significantly, consumers will change their habits and they will switch into buying, say, hot dogs, right? So it's not product for product. There's an idea of adjustment if costs rise by a certain amount. Second component to that basket is they change sometimes how they calculate it. So back in the 80s, housing was considered part of the basket, the cost of housing. Okay, that's a pretty big chunk, right? It was a big part of that CPI basket. It has since been removed and replaced with something that I believe is called the owner's rent equivalent. I'm pretty close on the titling for that, which means what would it cost you to rent your home? The idea for this is to more equalize the cost of housing, right? That have owners have a different cost of housing than renters. If you put that back in, if you calculated this bucket the way it was back in the 80s, it would actually be very, very close. It would be not quite double the inflation rates we have now, just because of housing. So I'm not, again, saying this to shock anybody. I just want to say that looking at past numbers of the definition of inflation, of what things were in the 70s or 80s and comparing them today, it would actually be pretty horrific. But I would say that very few people are suffering in the way that many people were back in the high inflation we had in the past. So that basket is adjusted for a reason, but it's hard to look at the numbers back in the past and say that's what they are today. I'd like to spend a minute, again, I'm going to answer the questions in a moment, but I'd like to spend a minute kind of talking a little bit more about what is probable going into next year. It is too certain to know. Okay, too certain to know. But there's something that doesn't get a lot of attention that does bear some conversation here, which is called stagflation. Stagflation is the economy slows down meaningfully. Okay, it's the economy slow, but costs are rising. And that's the worst of both worlds. Because again, if you're getting inflation, but the economy's heating up, it's much more adaptable and adjustable. Stagflation means you're not getting the economic growth, but the costs are rising. And this is a really important thing, and this would be the greatest concern, and it is a possibility that we need to be mindful. Everything I'm saying to you, I'm watching closely. For those of you who are clients and they're working with me, you know I'm paying attention to this, and if you have specific questions about your situation, I will answer them. This is very generalized information for the purpose of this. Stagflation becomes more complicated for all of my dear clients who are living off of their income. They're retired. They're not earning wage now. You're living off of your investments. You're living off of your Social Security. You're living off of stable forms of income. Because what happens is that's not growing, but your cost of living is, which means you draw down on your savings much more quickly. This is a challenging, it's a navigatable environment, but it's a very challenging environment, one that people haven't experienced in 40 years. So navigating that environment is going to be very, very important, and preparing ahead is going to be very, very important. And again, I bring this up because I can't stress enough the importance of planning around this if this does manifest, because it has nothing to do with your portfolio. It has everything to do with your cost in relation to your savings and keeping ahead of that. Another question I get a lot about this is, if we're having inflation, why isn't gold and tips and other inflation-related investments, why aren't they doing so much better? These are types of investments that people may invest in around inflation. Here's the conundrum about it all. Because of because of a number of reasons, but primarily because of the extraordinary measures that the Federal Reserve is taking by buying back securities, buying mortgage-backed securities, buying other securities to keep rates down, okay, in addition to pension funds and other things buying up Treasury securities and similar types of securities, interest rates have stayed very, very low. On the long end, sorry, I'm getting a little technical here, long end of the bond market, usually you would see a lot more movement around inflation. The bond market is not behaving like it's expecting inflation. And I want to share with you a little story about the bond market. It's way smarter than the stock market. Okay, so for my more spiritual crowd, you'll probably get this, right? There's the energy of the sun and the fire, and that's the action, and that's what everybody sees, and that's the power. And then you have the quiet moon and water energy, which kind of sits below all that, but that's where the real power takes place. So a little fun there. The stock market is the fire energy. The bond market is the moon water energy. Why is this? It is the most powerful. It is many, many times larger than the stock market, and it sees everything, and it reacts. I pay more attention to what it's doing, not day to day, because it can also be a little crazy. Over time, I pay more attention to anything else. It is one of the best indicators of what's really going on. So the bond market's not acting like we're having inflation, which is why you're not seeing other assets that would do well in inflationary environments do well. It is a number of reasons, but it's worth watching. So is that saying that the economy may not continue to grow at the rates that many are expecting? It's too soon to tell, but it's one of those things that is worth watching and paying attention to, right, with all of this. So inflation, not necessarily bad. You want to navigate this in your personal life. Don't fear it, don't overreact to it, but don't ignore it. And in your financial life. I say personal life because it does have impacts on things that, while they have a financial component, they're also for the enjoyment of life. But it is not necessarily something to be as feared as the news would oftentimes tell you. But again, is something to be planned for, because where someone can get caught flat-footed is a situation in which you just say, well, my portfolio is doing just fine, so I can keep spending the way I have been, and not watching the fact that your spending numbers are increasing at a rate that's not sustainable. Because if we hit stagflation, the growth rates in the portfolios will slow meaningfully. I will tell you, I will do my very best for you, but it's not going to be like the last couple of years. So we have to be very, very careful and very watchful of that, not to run out of money. I'm going to just stop here really quick and make sure I don't miss anything on that. This comes into the different questions about it. Okay, so I'm going to stop a little bit on the inflation side of it. I'll answer all the questions that you have, but I also want to talk a little bit about the markets. Okay, so I mentioned this previously in the last 2 webinars. I will say it again. We're going to be hitting air pockets here and there. Monday was a really fun one, right? The volatility will pick up significantly over the summer. You're going to get a lot more of this. There'll always be a reason. The news always has a reason for why this happens. The one on Monday was about the COVID variants. But that was really just an excuse for the market to do what it hadn't done for a long time and was overdue to do, which is have a little correction. It was actually a very small correction in relation to where it likely could have gone and maybe should have gone. We have more steam to blow out of this. We have a bit more to go on this process. Maybe not now, but down the road here. An important piece of information came out. Didn't get a lot of news, probably because it didn't fit anybody's political narrative. But I believe it's the National Institute of Economic Statistics or something like that, our Bureau of Economic Statistics, came out and said we officially were in the shortest recession in history, and it ended in April of 2020. Or ended basically in April 2020. Shortest recession in history. And they're the arbitrator of recession. So when they say it, that's the official word. We all have to follow it, whether we agree or disagree. It's important to know for one important reason, which means this has been going on for a while. The growth period, which is usually higher off the bottom of a recession and slows down later, we're into mid-cycle now. We're into the mid-cycle potentially, which means the growth may slow with more volatility. Valuations are very high in the stock market. That's an indicator that some people use is the market's overvalued, the market's undervalued. There are some companies where it's off the charts. There are bubbles. There is speculation going on. Late cycle IPOs are usually risky. There's a lot of frothiness out there, so you want to know definitely what to own and to not own in this environment. But there's also a lot of opportunity. There's a lot of companies who have not yet hit their run-up, okay? Especially companies overseas. A lot of the world has not opened up at the rate the U.S. is, and they're running behind us. There's tremendous opportunities in the U.S. and overseas, but you have to be more selective in this phase, as opposed to anything will go up. But there are speculation, there are bubbles, there are things that are really overvalued, and there's some companies that are really going to struggle to go higher from here. It's usually a little tougher in the mid part. So what that matters, it matters on what you own. It also matters that you may see more of this than you've experienced, the ups and downs, in this short while, okay? For any of you that are my clients, if this is making you uncomfortable anytime, please let me know, because on the next up run, we can adjust, because I want to be sure that everybody's comfortable with the ride that they're on. Again, it's not cause for concern on a broad base yet, but it is a cause to watch. There's another thing, again, I'm putting the positive and the negatives kind of mixed there. Another thing to consider is that we're almost the first month into this quarter, third quarter, and guess what? The data's not looking too good. We're kind of flatlining in a lot of areas. Again, it's not a cause to run for the hills yet. It's not, oh my gosh, we're all going to die. It's slowing rapidly. Less than 1 month into a quarter, it's not statistically valid. It bears watching. But it's a big jump. When we get, in a week or so, we're going to get the GDP data for the second quarter. That number is going to be so amazing. It's going to be so amazing. I don't know if it's going to be 7% or 9%. It's going to be a crazy number. A number that we have not seen for a long time. If ever, actually, I'm not sure what the highest number was. Amazing. But it is a direct result of the equivalent of $7 trillion being pumped in the economy, opening up the economy, and everything went crazy. So it's more of a sugar high than it is a real sustain. The economy's moving on its own, and that's highly unlikely to have anything like it replicated or any replication like that going forward. But the number will be great. I would imagine the administration will be very proud of it, and people will be very optimistic about it. But please understand, that's past. It's done. It's been done for over a month, and it's highly unlikely to do anything like that going forward. Again, not necessarily the end of the world, but it bears watching. It bears watching because sometimes there's an idea that things will continue at that same rate. Adjustments will likely be made, and into 2022, there'll be more of that, much more of that to consider. So bringing those subjects up because they were asked, and also because I know there'll be questions later on. Okay, let's see here. I'm going to get your questions here in just a second. Oh, maybe I should also explain kind of the why that we saw that jump. we had 16 months of spending of things that were held back in around a 6 month, not even 6 month, 4 or 5 month period of time. Massive amount of money was moved around and spent and used and went into the economy in a short period of time. Remember, I'd spoken previously about a lot of earnings that companies experienced last year was pulling forward from the future, especially in the technology sector. We did very much the same thing with the consumers, except we just pushed out that pent-up demand. A big part of the slowing, or noticeable part of the slowing down that we're experiencing in the short term has been the concern around the variant, the COVID variant. Okay? And there's a lot of questions that came to me about, is this variant going to cause us to lock down the economy again? Are we going to shut down? Are we going to go back to where we were last year? I would say it's highly unlikely unless something significantly changes. So the variant that we're experiencing now came from overseas, and it is much more contagious. Okay, again, remember, economist, not healthcare expert. Grain of salt in everything I say about COVID. It's highly contagious, and it's spread like wildfire, especially through the unvaccinated populations. So that concern is that are we going to start to see, the hospitals overwhelmed again, very high death rates? Is this just going to be another round of COVID? Is everything going to shut down? At this point, with the exception of a couple of cities, I believe in California, no one has shut anything down. And I could be wrong. Maybe there's been some changes that I haven't seen. And it hasn't happened. There's been guidance of change. Recommend, hey, put your mask on, vaccinated or unvaccinated. There's that extra level of diligence, but there hasn't been shutdowns. There hasn't been everybody go back to working from home. At this point, the schools are going to open as planned. Everything seems to be carrying forward. This is, again, by government regulations. Right now, we're government shutdowns or government-controlled actions. In that area. And it's unlikely to, unless we see a meaningful spike in the rates of hospitalizations and deaths, especially in vaccinated people. That would probably be the tipping point. And with this variant, it's been around for a while now. I think that is unlikely. Again, speaking as an economist, you don't have to take your health or COVID advice from me. Get shut down by Facebook or something. That's an idea of it. Now, of course, another variant could produce itself. Of course, there could be something we can't see. But at this point, from an economic perspective, the biggest risk to the variant is people getting nervous. People canceling vacations that they scheduled. People not going out to eat. People not doing activities, economic activities, because of their concern around the variant or COVID. So that's always a possibility. But it's more likely to be people's concerns then it's going to be government shutdowns if it continues at the trajectory it's going on. If anything interesting, a little data point, is vaccination rates have actually increased in areas where they were lower around this. So maybe that's, again, I know there's a lot of different opinions on this subject, but at this point, it's kind of a factor that we want to watch from an economic perspective. Again, that was question. It's always hard for me to answer because I don't want to come across as an expert. But I do want to answer because one of the questions came in around that and said, and this has been sort of asked before, but at what point of vaccinations is this kind of over? The question basically said, are we going to stop shutting things down? And this question has come before, but it's also came in again since we've had the variant. So I think it's worth addressing. We know how many people are vaccinated because they keep the records on that. We don't know how many people would get vaccinated. It doesn't account for people that can't for medical reasons, that absolutely refuse to. Nobody's going to change their mind. And it doesn't factor in the fact that people are coming from overseas and other countries every day. Even with strict testing of anyone coming from other countries into the United States to make sure they're COVID negative, we still got the variant. Most of the rest of the world, it has vaccination rates nowhere near the United States, even the least vaccinated parts of the United States. I bring this up from an economic perspective is that unless we shut it all down and seal ourselves in bubble wrap, I don't see us stopping whatever is going to be out there if it's contagious. So this may be something that's more ongoing for a long period of time. That I'm not saying whether we get vaccinated every year or whatever happens, but it may come to the point where it becomes less of a health risk and more of a a flu-like risk, and I'm not saying it's like the flu. I'm saying from a standpoint, is it something that keeps coming back and we have to continue to manage it? Again, I'm going to say again for my third time caveat, this is not my area of expertise, but we do model this out economically because we do want to understand it. It's going to take a very, very long time for the world to really get up to the vaccination rates that will probably get rid of, quote unquote, the virus. So it's going to be likely an ongoing thing. And anytime we have a new variant, there's always a concern that things may need to be shut down or people will restrict their activities or their behaviors. So it's very hard to model it. It is not the highest risk profile right now economically where things go sideways very quickly. All right, so I'm going to get a little bit into the government-related questions, and I'm going to answer your questions. Okay, so here's some trends that are taking place right now because this is a lot of the fun one, and I'll kind of give the most recent update on what's happening. Actually, let me do the government part first because that's not nearly as fun. So as a government slowly moves their way towards some form of infrastructure planning or infrastructure policy, there are two paths. One path is the bipartisan agreement. The other path is the all Democrats all the time way, like the Democrats version they want. I cannot tell anyone specifically what's in either one of these bills because they're not actually even sharing it with the economic experts that we get our information from in Washington. And I'm not saying they're not sharing it with us because they don't want us to know. I think it's still being negotiated to a point that nobody knows. I know earlier this week, the Republicans, I believe, in the Senate, I hope we get this right, were supposed to sign off or going to sign off on the bipartisan bill, but didn't want to do it because it hadn't been written yet or hadn't been finalized, hadn't been written yet. So there's a little bit more time going on that. So there's a bipartisan bill. And then there's the, again, I call the all-in Democrat bill. There's two major components, and then there's a whole lot of special interest stuff stuck in there. And please understand, when I say special interest, I'm not saying it's a good or a bad thing, only it kind of goes beyond the infrastructure. So there's a traditional infrastructure, which is pretty much agreed on, 100%, Democrats, Republicans, everybody agrees. We need to upgrade our roads and our bridges and our power grid and the like. That's kind of like a done deal. Then there's the, I think the word is human infrastructure, which is a lot more on the social programs and aspects of things like that are seen as human infrastructure. And then there's some other little specialized goodies that are kind of put in there, have nothing to do with infrastructure, but hey, while we're passing it, we might as well stick this in here as well, which is really common when there's big spending plans. At this point, too soon to say what it's going to look like. And everything you know is hyper-partisan. So it's very hard for me to say what this will look like, except this. It's unlikely to have a significant impact on the economy in the short term. The spending is over a 10-year period of time. All right? A 10-year period, this is best again, unless something's drastically changed in the most recent iteration of it. So it's going to be spent over time. Infrastructure, you don't snap your fingers and there's not tons of shovel-ready jobs out there. This requires planning. The money will be spent slowly over time. How we're going to pay for it, obviously a moving target right now. More deficit, higher taxes, a combination is unknown. But I'm bringing it up because it should not meaningful. It's not going to have the same impact of the money that was kind of sprayed out everywhere over this last year does. It could be beneficial to the economy. It could cause a drag on the economy. It could be a combination of both. But I will say anything that's spread out over 10 years may well be changed if there's a change in administration in the future, especially the further it gets outside of infrastructure or on more bipartisan agreements. So I bring that out there. When it passes, in whatever form it passes, this is being very important from an economic perspective, from a social perspective, and from a portfolio management and planning perspective. So I will be very much on top of that, and I'll probably dedicate a webinar to talking about that stuff. Okay, so the trends. There's a lot of interesting trends going on right now, kind of what I call under the surface, which is the rapid adaptation to technology in many areas of people's lives because it was necessary during the pandemic or very convenient. How much of this is going to stick as things open up and people go back to somewhat normal life? How many people will prefer to go back to the gym or they decide they like working out at home? How many people start thinning off some of the multiple subscription services they set up during this period of time. How much of what happened under COVID remains permanent, or at least for the foreseeable future, and how much of it kind of goes away over time? This is something we're watching very closely. One thing's for sure, though, subscription fatigue. A lot of companies that were bid up based on very high subscription rates, that was largely driven by the pandemic, we're starting to see the impacts. I'm trying not to generally mention stock prices on this, stocks on this presentation from the standpoint of this a general audience, but there's a few of them that are subscription services that have been really hit recently, and more that likely will. So that's an area that there's a lot of overvaluation there that's not sustainable, and we're probably going to see a lot of that impacted. So innovation overall is the key to everything. And by the way, innovation is very deflationary. It's very deflationary. Okay? Anything the government does to stifle innovation slows down our growth. That's an important thing to know. There's a lot of benefit to having innovation and continue to support and sustain innovation in our nation. From an economic standpoint, it drives more money and more opportunity and more ability, basically, as well as it's deflationary. So innovation is going to continue. There is that kind of thing that's sort of hanging over everything, which is what if the government gets in and heavily regulates tech, or breaks up tech, or taxes them to the eyeballs so they can't go out and do what they do. And that is a concern bear watching. Yes, it is a concern bear watching, because if it chills the innovation, it can put us at a disadvantage, which again, our disadvantage is China's advantage, is our competition overseas advantage. So it's a big, big balancing point between regulating tech and also allowing for innovation and for freedom to continue to develop for, again, national security as well as the economy. So innovation is by far, and there's so much of it going on. I cannot stress enough with it. For those of you that are geeky like me, look up synthetic biology. Okay? Can you imagine if we can create stuff that now we currently take from plants and animals? Okay? Imagine if we could create it without. Imagine if we can create stuff from yeast. And, okay, some people may or may not agree with this, but it's a slight alteration of DNA. It's a slight adding this to that. I'm not going to get into it here. I have reports on top of reports. It would probably take up its own webinar. But I throw that out there because we are finding more and more and more ways to do things more efficiently, with less waste, with less use of resources, better for our planet, and better for society because it reduces costs, which equalizes access. So there's a lot going on in that place. I just pulled up synthetic biology because it was kind of fun. Do you know that they're doing amazing studies with tobacco in healthcare? No, you're not lighting up a cigarette and taking up a habit. But the tobacco companies have expanded into, they know the future of cigarettes. I mean, you can see the consumption of cigarettes. They know the future just like the fossil fuel industries know the future, right? With or without government intervention with it. But they're doing amazing things. And some of the companies that people go, ooh, they're actually doing some amazing things in healthcare. The results of a lot of this RNA work around the vaccines have created huge breakthroughs in other areas of healthcare. The human genome and its understanding of that, and treatments and medications specifically generated for your specific makeup is big. Again, there's so much going on right now. When I talk about the negative, I talk about the things to be concerned about. I cannot stress enough the positive. There's a lot going on, a lot of innovation, a lot of opportunity. And to be able to move out of the areas that are kind of overdone and move into the areas that have opportunity it requires a deft hand, and it requires a long-term perspective. But there's a lot going on here. When you keep everybody at home, the smart minds just to get together electronically. They get together through the internet. They get together through Zoom. But they're talking to each other, and we had huge breakthroughs in a lot of areas within technology and within innovation over this last period. And they're up-and-coming areas. So that for that question. Okay, I think I've covered like the big questions, the big parts of it. The high level of it is we have record high savings in this country collectively as a whole. All right. Everyone obviously is not in the same position. Record high savings. Record high savings. A slowdown in the economy does not mean a recession. It just means you're not going to be driving the race car. Things are not going to go straight up. Okay? Slowdown does not mean recession. Plan and prepare. Be aware of the changes and adjust things as necessary. Not through emotion, not through fear, through understanding of your specific plan and your specific goals. There's a lot of different ways to do things. There's one right way for you to do things. So that's the thing. But do expect that to continue. And when you have a correction, there will be something really bad in the news and you think, oh my gosh, it's all over. And you know what? One day it will be. That's my job, to keep an eye on this. Customize specifically for yourself. And I cannot stress enough to look very carefully at your specific situation. Plan, update your plan, and be sure it's lined up. Because if we do go into a stagflation environment, if we go into a slowing growth environment, if your portfolio is not doing what it's been able to do over this last 12 years or so, then how are you going to be okay? How is things going to work out? Are you well invested? And I give you an example. Okay, this is a little bit geeky, a little bit further up in the investing side. But recently what's happened is that the S&P 500, the index, is weighted by market capitalization. Okay, which means the largest companies like your Apples and your Amazons, they're the biggest percentage of that portfolio. And it tiers down, and company number 500 is the smallest part. So it's kind of like an inverted pyramid. Okay, so that's how the S&P 500 works, the index. There's also funds that take the S&P 500 and equally weight them. So your Apple and Amazon are just as big as your smallest companies by weighting, by percentage. So how we have tons of indicators and tons of data that show us this in the technicalities of my work. But there's also a very quick way to see, is the economic growth sustainable? Is there breadth? Are all companies doing well, or most all companies doing well? Or is it just a few that's dragging everything else up? And that's how you can tell between those two indicators, right? So if the top big companies are the only thing doing well, or what's doing mostly well, then you will see the drive up in the index over this other fund, right? When you see weakness in most of the companies in just one or two or just a few pulling it up, that's a sign of overall economic weakness and slowdown. And that is what we're experiencing now. It was a long way of telling you a simple thing is know what the heck you own. It's not a time to be generic. It's not a time to be, oh, this works. It's a basket of everything. Really know what you own, because that's going to split further and further and further as we get later into this cycle. And that's, just something it's kind of really important to bring up, because it's something oftentimes it's easy works when things are easy, but they start to fall apart a bit when things get a little bit rockier or just don't do as well. So, you want to make sure the engine's clean and everything's operating at its best capacity. All right, I'm going to jump into the questions here. Okay. Okay, this one asks are you and your team certified fiduciaries? Yes, we are. We are fiduciaries. Sequoia is fiduciaries, as myself and our team individually are fiduciaries. Now, there is one word that was found there, certified fiduciaries. So I want to make sure I define what fiduciaries means. We are not fiduciaries over trusts. We are not, we don't step in as fiduciaries over trusts, become a trustee and things like that, but we are fiduciaries in the work that we do for clients. There are different levels of fiduciary, so please reach out to me directly so I can explain that to you in a way that makes sense to you. So I'm understanding it correctly. Let's see. Can you do a presentation on what you watch in the bond market and what is suggested for the overall economy? I can, but most people would find it very, 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 very boring. So what I would do is I will tell you directly what I watch for. And on a high level, it depends on what it is I'm trying to see. But on a simple level, the short end of the curve, the intermediate end of the curve, and the long end of the curve of treasuries and of the overall bond market tells me a lot. But there's many other things I look at, and like I said, I'm not sure how much of our audience would be really into that, but I love talking about it, so I'll talk to you because I know who you are. Okay, let's see. Other question. The news said people are leaving California, and then the news said people are not really leaving California. Which is true? And if they're leaving, why are housing prices so high? I may have mentioned this before because I speak at some different events. California is about 1.5 million houses below what it needs for the population. So a lot of people could leave California and we still would have high housing prices. As far as the different reports about how many people are staying in the state and how many people are leaving, there's actually no way to really verifiably know that. You can get that data because there's too many variables. For an example, if someone goes out and buys a second home in another state, but keeps their home in California and rents it out and moves to this other state, are they still seen as Californian? They didn't sell their house. That won't show up in the sales data, and that sales are not a repurchase. They use the U-Haul data, right? People leaving the state and moving. A lot of it's kind of subjective. It's very, very, very hard to know. I always joke that with the exception of the census, the only time we really know is tax revenues. It's kind of a joke because obviously people are, tax revenues also fluctuate with the economy. There is, definitely a lot of people leaving California for other Western states, but there are also people moving around all over the country. So it's hard to say. And it's not statistically valid from what I see, especially with our Nevada office, there are a lot of people leaving California, primarily because of cost of living. And that is certainly happening. To what extent, I don't know. And back in the past, what happened is people were leaving, this is past, when I say past, pre-COVID. People were leaving California were primarily people that were retiring and getting out of the state, cost of living, lower education, lower income level. So it's and then people coming in were primarily high education, high income, and of course it made sense coming to Silicon Valley for the tech, right? Coming to Silicon Valley, that's where you could make the most money. But that seems to be changing now by the subjective data out there is the people leaving are well-educated, well-paid, wealthy, as well as the people that are trying to find lower costs of living. All subjective data. I've seen and heard and can see in a lot of data, there is a lot of people moving out of California, but a lot of people's subjective. And this is not a representation on California. I think people should live wherever the heck they want to live. There's a lot of variables. It's not just about the cost of living. And real estate in California, like I said, if you just simply don't have enough homes for the population. You don't have enough homes for the population. Will that change over time? Will enough people leave? We'll have enough homes? Will we build enough homes to make more housing? It's more than I can speak to. But housing prices, even if they stop growing at the rate they are, which is highly probable, a correction beyond 10 or 15%, and that's if we get a recession, is unlikely unless we do something really squirrely to drive people out of the state. By the way, I said we. I'm not in politics, so I'm not doing anything. But our government, our state government drives people out. Biden's tax plan, is it going to be retroactive? I keep hearing that. It's going to be retroactive. Should I sell this year? Unlikely at this point to have it be retroactive given how late we are in the year. But never say never with our politicians. Right now, they're still working on infrastructure. They're rolling the tax plan into it. In the Democratic version, they're rolling the tax plan into it. We don't know yet what's actually going to pass. The Democrats barely have enough votes to get it through. And they're already, they're right at the line, right, of the Democrats to Republicans. They have just just the one extra vote, right, with Kamala Harris. That's it. They have to have their whole party on board or some Republicans on board to get this done. The more they add to it that's not bipartisan, the less likely that is to happen, both within their party and outside of their party. So it's very hard to say what of the tax policies will go through. There's some pretty onerous stuff in there, and there's stuff that it passes, you're really going to want to plan around it. Some is immediate, like the taxation of capital gains and things like that. Some may not be immediate for you, like the loss of step-up in basis on inheritance and things like that. All of this will bear important planning, just like every single tax reform of every single administration before and in the future. Plan around this stuff. Your only power in this, that's why I say don't worry about it, your only power is voting. After that, your only power is planning. But in the meantime, there's not much to worry about because there's not really too much that you can do or should do, not knowing what's going to happen. And if you don't have to sell an asset, perhaps, and this is a perhaps, you can just wait for the next administration and whatever changes that they make. So individual advice, no general advice on something like this. I'm coming up on my time and there's a bunch more questions. Okay. Will the economy shut down again because of the variant? I think I answered that one. It's highly unlikely at this point unless there's another variant that's worse or more dangerous. The thing to watch very closely is the death rates and the hospitalization rates in the areas that are most impacted. That's more important. They talk about how many people caught it. If people don't get seriously sick, it's not going to be a big deal from the standpoint of shutting the economy down. We know so much more about this virus than we did before. We know that the vast majority of people who catch it have little to no symptoms. And there are people that are at greater risk. And we're better at knowing how to protect those people and still having things operate and run. So at this point, don't think so. It's not the high on the priority, but it does bear watching because if the numbers meaningfully change, I would say on the economy, a bigger impact is going to be if the kids don't go back to school in the fall and the parents can't go back to work or have to work part-time. That's going to have more bigger economic impact than if we put masks back on again or something like that. I think I answered this one. What exactly is inflation and what is the risk? Layman's terms, please. Well, if you are listening, I hope I was layman term enough. I get really passionate about this stuff, and I see it all in my mind in charts and graphs and geometric patterns, and then I try to talk about it, and it makes perfect sense to me and may not make sense to everybody else. Please, 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 if you have questions, reach out to me. I will find a way and time to be able to get the information back to you so it's spoken in a way that makes sense to you. A few questions about the infrastructure plan, what's in it, and if it's going to pass. I believe I've answered that. Is the government spending causing inflation? Okay, I got hit these three questions. Yeah. Yes. Yes, in many ways it is. Economically, we did not need the last stimulus. But President Biden came in and he wanted to show he's doing his part, or do his part to help the economy around COVID. At that time, things were pretty locked down and there was a lot more uncertainty. And, I guess $2 trillion was the target, and roughly $2 trillion it was. It was just a lot more money than we needed, and that was a big part of what goosed things up so quickly, and which has caused a lot of these issues. Because it coincided, here's a lot of money in the system to states that didn't need it. California, already record surplus. They had no need for money, and they still got $21 billion, or whatever that final number was, maybe more. Money, it was like, I say shotgun approach, but it makes me think of if you go to a sporting event and they have those guns and they're shooting randomly sports memorabilia out to people, T-shirts or whatever. It's like that. Here's money, everybody, money. All you don't need it. Who cares? You can have it anyway. You might need it. It was just really, really not well thought out distribution of money to areas that it wasn't needed, at the expense of areas where that same amount of money could make a really permanent long-term difference, especially on the most vulnerable amongst us. So it was not economically, was not well run. By the way, I'm not in any way trying to take a political stance on this. I'm saying that our politicians sometimes do things that don't always make economic sense. Not picking on one side or the other. Anyone who've heard me talk, I pick on everybody equally. But a concern economically is a lot of money was thrown in the system, wasn't needed in ways it wasn't needed, and that limits our ability to do this in the future because we have a tremendous amount of debt. And nobody knows the amount of debt that is a stopping point for us as a nation. It's unknown. But every time we pile more on, we get a bit closer to that. And it is a concern because everything that we hold dear could be easily lost if we lose our power economically in the world. All right, I'm going to skip past our stocks overvalued because I think I covered that. Well, maybe I'll just add 2 lines in case someone's tuning in at the end. Some are grossly overvalued. Some are pure speculation. It will end poorly for the people that are investing in these stocks. Others are grossly undervalued. They're completely ignored. Nobody's thinking about them. It's a mixed bag right now. And now we're in the middle of earnings season. Valuations get reset because we see not only is your price justified by your actual numbers, so I always call earnings season the grand reset because the valuations again, but the guidance going forward. How much is inflation impacting companies? How much is the lack of labor availability affecting companies? It's a big deal right now, companies being able to find workers. A really big deal, which is stunning in an environment we have such a high unemployment numbers. People, for many reasons, don't want to go back to work. And these are not just low-paying jobs, even good-paying jobs, that require some degree of skill, but not that specialized skill. They can't get workers. It's a really difficult time for companies as things open up. But that throwing all that money in there in the second quarter, just as we were opening up, was kind of what kicked inflation into gear and what's kind of made it sustained. And again, which you'll see in that unusually high GDP number coming out next week. The last one, because I almost missed this actually, so my apologies. There was a question because it was kind of talking more, asking about the taxes, fair taxes around the ProPublica report. So for those of you who didn't hear it, the report came out, I think it's ProPublica, something like that, a media organization that basically released the tax returns of some well-known wealthy people like Jeff Bezos and Elon Musk and some others. And basically the whole narrative around it was that these people weren't paying their fair share in tax. They weren't paying any taxes or paying little to no taxes. And so the question kind of was long, but it kind of went to, what do you think about this? And do you think taxes should be higher and more fair and equal and whatnot? And when I saw it, I never read the full report. I read just the high level. The first concern I had, and this is just something a little bit outside of economics, is this information is private and confidential. Why is it being released by anybody? I mean, if someone hacked into a system and stole confidential information and a media organization is publishing it, that's concerning to me. But that's a whole privacy issue, right? The second part to it is that none of these individuals are my clients. So I can't speak for their specific situation. But I do work for people in similar situations. And I will say that when data is cherry-picked, like, oh, here's the 2015 return. Oh, for this person, we have this. Data is not like, here's 5 years of everybody or some equal, right? When data is cherry-picked, it's possible that it's selected specifically for a narrative. And I'm not, again, saying this is true because I don't know. But it is quite possible that in the case of people that founded a company, have a lot of stock in that company, work for a company a long time and have a lot of stock in that company, certain types of stock options, they basically expire in a period of time. You have to sell them, okay? Or they become worthless. So what often happens is someone says, I've got all these options, they're going to expire, I need to sell them. And they sell them, and then there's a massive financial impact, right? And they pay massive taxes. And then they don't need to do anything for the next few years because they're kind of set. So when data's picked like that, there's no way of knowing whether any of these individuals sold a whole lot of stock, paid massive amounts of taxes. And in the case of Elon Musk, if he was a California resident, then a massive, massive amount of taxes in year X, and then didn't need to do anything in the subsequent years. And I'm only bringing this up, again, not saying that's what happened or what didn't happen. The idea of it is that in the absence of all the information, it's really hard to know if it's quote-unquote fair or not fair. Could the taxes be changed? Tax policy in the United States? Certainly. It's certainly, there's a lot of room for change there. I'm sure it's up for a lot of debate on how. There's a tremendous amount of room for change. I always thought a flat tax would be nice because then everybody have a little skin in the game. But that's sort of the take on that is that there's a narrative, there's carefully picked information that was shared, and what does it really mean in the absence of any of these individuals coming out and saying, hey, look, here's my previous year, look how much I paid. It's kind of hard to say, but it is a reminder that, tax policy can be reviewed on occasion. I'm coming up to the end. Sorry about that. I have more questions than I thought. I apologize for this being a bit disjointed. There was a couple of other things that I sort of wanted to cover, but it was most important for me to be on time with all of you and to be able to get this information out. I'll go into it probably in a deeper dive as we get into the quarter because I really want to talk about specifically with data and facts about what is growing and what is not growing when we get further into this quarter. In the meantime, thank you very much for listening. Thank you very much for the confidence that you have in us and the work that we do for you. I have tremendous amount of gratitude for that confidence that you have, as well as a tremendous amount of caring and concern and caution in getting you through these times and through all the times in your life, all the changes that are taking place. Remember, the financial aspect of it is the economy, all the things I talk about, they're just a piece to the puzzle. They're just something that's going on. Fortunately, I love it, so you don't have to. You can come to me with questions when you have it, but it's more just to understand kind of the world we're in, more than a cause for concern or fear or worry or anything like that. Your best and highest purpose, the reason you're on this planet and doing what it is you do, is not to worry about these things. Intellectual curiosity, you want to learn more, you want to understand more, I'm here. I love to talk about it, I love to share it, and I love to make it specific for you. But on the highest level, things are going to get bumpier. Things aren't always what they seem, but everything is navigatable. And I thank you again very much for your confidence in the work that I do with you. And any questions, please reach out to me. I am more than happy to answer them. Thank you all very much and have a wonderful afternoon. I'll talk to you whenever you're ready. Bye for now.